Now, moving to the next talk, we have Miss Vidhi. She is working in Deloitte, of course, the big four companies, and they have their own ways of working. And of course, the focus is definitely on diligence and legal aspects. And she's currently based in London, and I managed to catch her in the nick of time. I believe she was moving tomorrow to Scotland. Yesterday she was in Bristol, so it's very kind of her to give some time for us. So over to Vidhi. I would request her to share the screen and take over. Thank you.
Thank you, Pratik, for the introduction. Um, just a brief introduction of myself. I'm a chartered accountant and I've been working in Deloitte since the last 2 years. My focus of work includes due diligence for M&A transactions, mergers and acquisitions. And that's what I will be primarily talking about today. Um, but yeah, firstly, I think a lot of you will have a lot of questions around what exactly is due diligence, why due diligence, and how is it even relevant to you? So I'll try to answer all the questions by the end of the session, hopefully. And if in case you have any questions, you can just type them out and I can take them as we move forward, or I can take them at the end of the session. Um, so getting back to due diligence, what exactly is due diligence? So as you can see on the screen, there are a few definitions, you could say, of due diligence. It's basically an investigation, audit, review performed to confirm the facts of matter under consideration. And it's used a lot in the financial world with all the big jargons and everything. So yeah, these are just a lot of big words, which I'll try to simplify them and break it down to you. So the term due diligence basically refers to research done to ensure a deal or an investment is legitimate. It's basically a research that is being done, an investigation or audit or a research. Um, so just to give you an example, there's a lot of data available out there for you, and you have to sort of um, figure out how to go about that data. So as an example, if you want to invest in something, you don't blindly invest, do you? You do some research, gather some information about a particular investment or product, and then after analyzing the risks associated with it and weighing the pros and cons, you decide whether to go for the investment or not. So due diligence is basically the same thing. You're just researching about something. You're investigating whether it makes sense, whether it's feasible for the investment. And it also identifies a lot of risks and problems that are associated with your investment. And one part of analyzing these risks and unexpected liabilities is that it adjusts your purchase price. So it will sort of adjust your buying or purchasing power. Because if you know that you're buying product X, but it has a few liabilities and you may have to pay for them in the future, then you'll definitely want to adjust the price today, because you don't want to pay extra today when you know you're going to have to pay anyway again in the future for that. So this is like the gist of due diligence and why we do it. There are obviously a lot of different types of due diligences that are performed, and for a lot of various different reasons as well. Investment is one of the biggest reasons that we um, do a due diligence. And I think for M&A transactions especially, it's quite important because it gets both the buyer and the seller comfortable around the pricing mechanisms, around the asset that is being valued, and around the legal aspects as well. So I'll just move on to the next slide where I'll talk about types of due diligences. So like I mentioned, there are a lot of different types of due diligence. Um, the main one, which we look at in M&A transactions, is financial due diligence, or even if, like I said, if you want to invest in something, that's the main one that you look at, like the financials of a company, the income statement, the profit and loss, the balance sheet. I know these terms might sound a bit alien for some of y'all, but it's basically the financial performance or the financial health of a company, which you analyze. So financial due diligence is basically where you examine the financial statements, related financial metrics, and future projections as well. Um, are there a few examples, a few questions that you would ask? So due diligence is a lot of questions. So you ask a lot of questions in order to get comfortable. So few basic questions that you'd probably think about are, how is the financial health of the company and how will you analyze that? You look at the financial metrics, the key metrics of a company. Are the margins of the company increasing or decreasing? The revenue, the costs? Are the future projections that the company has given, are they reasonable and are they believable in today's scenario? Um, how much of working capital is required for the company? And working capital is your day-to-day cash that is required to run the company. Um, what sort of capital expenditure would be required um, for the company to sustain? And capital expenditure could be investment into your IT software to make it more digitized, um, investment into, say, a big machine or an asset for production, those kind of things. And then for your capital expenditure, you obviously need cash. So you'll have a lot of, you'll have to apply for a loan. There'll be debt in your company. So analyzing that debt, analyzing the covenants of that debt, and the covenants basically mean ratios that a bank would want, which assesses the financial health of a company. That, okay, if I have that 100 rupees of cash, I want the company to at least maintain 80 rupees so that if they have to pay us back, they have some reserve to pay us back. And then, is there anything unusual in the company? Does the company have enough financial resources to cover costs of a transaction if they're getting into a transaction? So these are just some basic examples of what you look at in financial due diligence. Um, in a lot of cases, the company does provide future projections as well, because it's relevant to know how the company would be performing 4 years, 5 years down the line. And in such a case, the company, or we usually help in assisting them in building a financial model, which is gathering information on the current scenario, how the company is doing historically, that is current year, past year, 2 years ago, building that with your commercial factors and economical factors such as um, inflation for the year, any policies, government policies, tax policies, any changes, and ensuring that sort of flows into the future years so that you get a future projection of the performance of the company. Um, so that's a part of the financial due diligence bit. Technical due diligence, while I don't have much of an experience in this, but this is usually a general health check of your systems. It's identification of IT assets and risks, where you also evaluate leadership, team and organization of the technical company. And a lot of CTOs of companies usually own the process of due diligence because they definitely have more knowledge about the architecture, the processes, the software, the products that are being used, the annual IT maintenance cost, and the capacity of usage level of existing systems and stuff like that. Um, so I think, yeah, technical and IT due diligence is quite relevant for in the IT sense. And especially now, because a lot of companies are just switching to IT. So you may not have a software in your company right now, but you will definitely need one in the years to come, because everything is going, everyone is looking to automate everything. So how you evaluate your tech architecture or structure is very important. Customer due diligence is a process of identifying who the key customers are of a company, um, and just sort of doing a background check for your customers, you could say. Just to give a very basic example, when you open a bank account, they usually do a KYC. So KYC is just a short or basic due diligence requirement. So it depends on how big the customer is or how complicated the company could be with their own branches and other legal entities. So customer due diligence could again go into um, figuring that out, who the key customers are, whether they engage in any illegal activity, whether it's safe to get into business with them, and all that. Um, Now I'll move on to other types of due diligence, which is human resource due diligence. This is actually quite uh, it's very extensive type of a due diligence. It can involve anything from analyzing current employees and the salaries to determining a potential labor impact. And you generally look at the company's management, employee base, corporate structure, current compensation that you're offering to officers, directors, employees, benchmarking the compensation, um, looking at the company's employees and companies' health benefits, incentives and bonuses, what are the policies, and doing a detailed background check. And this can become quite relevant in cases where a company is merging with another company and you have your current employee base moving into another company where you need to integrate both the employee bases together. So another type of due diligence is environmental due diligence, where you want to make sure that you're not breaking any environment related rule or regulation and you're following all the policies and procedures correctly. You have all the permits required, the licenses required, um, and the disposal techniques. This again could be very relevant for construction related assets where your the asset is um, useful for 10 years, but then after that you sort of have to dispose it or decommission it. And the main thing is, how do you decommission it? Are there any rules that you need to follow to decommission it? Is there any um, local regulation that you need to follow? And do you need to pay any tax or any to any other local authority and stuff like that? And another very relevant due diligence is a tax due diligence, where if you're buying another company, you would have to look at the tax liability of the other company as well. And it gets more complicated when they're operating in different countries, where you have a certain tax obligation towards the country. And when you're working in that country and you try to repatriate money back to another country, you usually have a lot of regulations and norms to follow and restrictions as well, because you can't just transfer all the money. You need to withhold some money in some country. Um, so tax plays a really big angle in that, where you have to check whether you can actually transfer money from one company to another in a different country and whether it actually makes sense to invest in that company. Because if you cannot transfer money back, what's the point of the investment? Because eventually you would want some returns on your investment, right? And you just want to ensure that there's no underreporting of taxes so that you don't get into legal assessments. So those are some of the types of due diligences. Um, the next bit is stages in due diligence. So how does a due diligence process work? And who are the ones who do it? Like how does it work? Who initiates it? So in the beginning, you'll have, it's quite basic actually, like any legal agreement. You have your introduction where you have a kickoff call where you're introducing both the parties. You, if I'm from the buy side, I will go and meet the sell side and um, the seller of the asset and any other, and they'll probably hire the broker. So it's a meeting between those parties, and you'd want to understand why they're selling, what they're selling, and at what price are they selling. And then you have a scope of work where you decide that, okay, in my due diligence, I'm going to look at A, B, and C. Like maybe I'll just look at financial, tax, and environment. Maybe I don't need to look at customers and human resources because I'm comfortable with that. So you agree on your scope of work, what you're going to be looking at. You have a look at the business model and um, whether it aligns with the investment that you want to make, or the company that you're in, whether it aligns with that, um, whether the business models are in line and whether they are similar to each other. The funding story, which is how has the company survived so far? Have they received funding from um, from somewhere? Have they obtained a loan? How have they managed to survive so far, and how have they got the money, and what have they been doing with the money? And other basic things like investor expectations. And a lot of times, uh, quite a lot of merger and acquisition deals could be confidential, because they're big companies and they could affect public earnings if they are listed companies. So in that case, during the first phase, when the introduction is happening, you sort of get into a non-disclosure and confidential agreement, which is, yeah, you sign them and you don't speak about it again. You just concentrate on your work, something like that. And then once you're done with your introduction, the next process is screening, where you basically gather information and you analyze the information. Now, one part of gathering the information is how do you gather the information? You don't really exchange files anymore because it's too much of paperwork, and a lot of information is just digital. So it really makes sense to have a virtual data room where you upload your information and the other party can log in and view that information, and if they have any questions, ask through that virtual data room. So the virtual data room is where everything is happening, and monitoring that is really important. And through that virtual data room, you can do a thorough inspection of a lot of documents, such as your business model, your architecture, your funding requirement, capital expenditure, and stuff that we spoke about earlier. Another part of the screening process is you basically identify your business and you analyze it. So you'll analyze a lot of your core and non-core business operations and assets, where um, you may not want to spend too much time focusing on the non-core bit because you're only interested in the core asset or the business. So you may want to then make a detailed plan identifying the core assets and listing down what you want to identify or analyze within those core businesses and assets. Then you have your site visits planned, where once you've identified the core and non-core bit, you'll go and probably you'd want to visit the site and see how things are over there. Like if you're investing in a business park, you'd want to go and see that business park and see how things are running and whether you wouldn't want it to be a shoddy or shady place. Um, so site visit is also a very important thing. Business plan and model analysis is again what we spoke about earlier, that you'll analyze the business plan. If the seller has come up with a financial model, you'll go through the financial model, go through the future projections. And because due diligence is nothing but questioning and challenging the data in front of you, you'll sort of challenge the assumptions that have been used for coming up with the financial model. You'll meet the team and go through the organization structure and the IT architecture and systems. And you also have an interview with the management team where you get into a face-to-face discussion and ask whatever questions you have and try to get comfortable with the answers. So once you're done with the screening process, you have all your information, you've made up an opinion, you've decided on what your course of action should be. You go on to the next phase, which is basically reporting, where you assess the impact of the due diligence findings, you report on them. Based on your report, there could be an adjustment to the transaction price. So um, then you negotiate the price, the terms and conditions, and then you submit a offer for for the investment or for the deal. And once that has been approved, you need money to invest. So you'll probably secure financing if you already do not have a big cash pile of cash that you're sitting on. And when I say you, I actually mean company. Most of the companies are not individual business person per se. And once you've invested or merged with your company, you will also want to manage your integration plans. So when company A is merging with company B, you will have a lot of systems in company A and B that will need to be integrated together, like the employee base, the IT systems, the and you'll realize a lot of synergies while doing that because a lot of cost savings would happen in such a scenario. So I think in terms of tech DD or IT due diligence, where we've seen that a lot of startups obtain funding, such as Seed A funding, Seed B funding, and so on. So I've just tried to think about the stages in tech DD and the type of due diligence you would require for that startup. So in a seed A, like the uh, initial phase where you start your own company, you're focusing on building the company, and the due diligence that you would do would be on the potential of the company. So your assets might be under construction, and you would focus on the under construction assets, and you would look more at capital expenditures because you need money to spend on building the assets or building your IT system or infrastructure. When you're when you're at the next stage, you'd want to grow your business, and by growing, you'd one thing that you'd look at is the scalability of the business and the ability to adapt quickly to changes and how fast it can move forward. And once you're a mature company, your focus on due diligence would be more on how do you maintain the current state of the company, how do you continue making profits, and the compliances. And if you do want to exit from the company, what are the options you have available, such as IPO, or then if you want to sell, then yes, then you get into a transaction and we start the whole stage again, such as introduction, screening, and reporting. So these are some of the stages in due diligence. Now I'm going to talk a little bit about IT due diligence. So what happens in an IT due diligence scenario? What are the things that we look at? Um, so again, a lot of CTOs are the ones who own these processes, and they are the ones who deal with the architecture and the high level stuff. So in an IT due diligence scenario, you assess your hardware, the operating systems, the softwares that you have, the licenses that you have, the hosting, and monitoring of your IT systems. You'll also be interested in the security, which is going through how well the firewall works. Are they in compliance with any regulations or rules that a company is required to comply with? The data encryption, so that you do not have uh, loss of data, hacking of data. You'd want to ensure cybersecurity. Um, then you have your intellectual property assessment, where so the buyer will actually be very interested in the extent and quality of the technology and intellectual property, and it focuses a lot on what sort of intellectual properties does a company have: patents, trademarks, copyrights, trade secrets. Again, and if there are domestic and foreign patents, are there any patents pending? Um, has the company taken appropriate steps in protecting their intellectual property, such as confidentiality, assignment agreements? Um, and a lot of time, intellectual property is nothing but what's in your head. So a lot of employees, they work on processes, they know how to run a machine, but you can't really quantify that because that's all knowledge of a particular person. So one way that a company tries to protect itself is by entering into agreements with the employees, non-confidentiality sort of agreements, where you cannot disclose information while you're working with the company, or maybe even after. So these are just some of the ways where the company will try to protect itself. Then other things such as scalability and resilience. So scalability, like we spoke about, where you want to continue the growth of the company, where you want to see how the company adapts to the current environment, um, and what product development plans they have. So you look at those information, analyze that, and if there's any risks, you identify the risks and you report on them. Business continuity and disaster recovery. I think this is very much relevant today because COVID-19 has impacted a lot of businesses for sure. And if a company's architecture is powerful enough to sustain even during such a pandemic, um, I think it has surely passed the test, and that would be considered as a strong company, and the valuation will definitely increase because of that. Customer support is a company heavily reliant on customer support processes, such as not KPO, a knowledge processing outsourcing center. So these are some things that you would look at while performing an IT due diligence. And a lot of startups have to go through these processes even just to obtain funding. Because again, anyone wouldn't just invest in the startup for the sake of it. They'd want something back in return. And uh, some of these questions were just the basic ones. Um, so to properly evaluate the risks in a company's IT environment, you need to holistically look at a lot of different IT processes, such as proprietary technology, which is the architecture, the software that the company has, the roadmap, and the costs and projections required for maintaining this proprietary technology and any investments going forward. Um, Data and analytics. This is another very important thing where you'll go through the data integrity, how the company uses its data, how are they able to manage the data, analyze the data, and how do they use it for reporting purposes? Because in the end, um, data is useless without a meaning to it. So they try to build some meaningful conclusions from the data, and how are they able to do that is a key thing to look at. Security and compliance, because of course, uh, you would want some security in the company, and a lot of controls, physical controls, logical controls to um, the company's assets and the software, compliances, and costs which are required for um, getting in line with the security part. Infrastructure is again very important because how you're hosting your data is very important, whether it's in a cloud form or whether it's in a hardware or a data center. And the agreements entered into for storing the data, the hardware, and the performance of the infrastructure is very important to look at, because if that fails, then I mean the whole company could just crash or the data would go missing. So that's really important to as an investment question or as a due diligence factor. So these are just some of the basic ones. I'm not going to run through all of them, but just to give an overview of how what you would look at in while performing an IT due diligence. Technical and project due diligence. So project due diligence is again very important, and this is something that mostly only engineers can perform because they have that technical background and because they know how the asset works. They know how to build the asset, and they are the ones who maintain the asset. So like you see in the picture, when you're investing into something, you'd want this. You're thinking you're getting this, but what if you're actually getting the picture on the right side, which is just a complete mess? I mean, in that case, you clearly did not evaluate your investment portfolio properly, or you did not do your due diligence well. So another part of due diligence, apart from looking at just the financial bits, is looking at it in an overall view, where if it's an asset incentive company, you'd want to make sure that the assets are functioning properly, and you'd want everything to run smoothly. So a lot of asset incentive companies where include construction projects, where they're often very risky, complex, and a lot of parties, because you're building an asset. It includes a lot of other things such as subcontracting it, because maybe another company or another person is building some part of the asset, you're building some part of the asset, and then you integrate both. Um, so this is where a lot of capital expenditure also comes in, and you have to be very careful with that, because you'd want to know where your money is going in, what kind of an asset you're building. So this is where I think you need to sort of engage engineering and construction specialists who have those skills to look at the asset and to figure out whether it makes sense to invest in it or no. So just to give an example, one of the projects I was working on involved investment in a wind farm asset. And this was an offshore wind farm asset where it was located somewhere in the middle of the sea. And we obviously have no idea how it works. but we did have to engage with engineers. Uh, so who reported that, okay, yes, this asset is working fine, because a lot of things which we otherwise would not have thought of, such as um, maintenance of the wind farm asset, the turbines of the wind farm. Do they require replacement? Are they working fine? Um, the generation of electricity from the wind farm, the architecture that they have, or the supply port that is there, are they all functioning properly? How much of a maintenance is required? So this is where a lot of specialists come in, and they go on site, evaluate the asset, see whether it's working properly. If it's not, we engage with them to figure out, okay, what requires maintenance? Who will have to do the maintenance? How much will it cost? And ultimately, I think you just want to get comfortable on the asset, because you'd want to make sure it's working well. Um, so that's project due diligence in a gist, where you're looking at the construction assets, and you would want to make sure that um, you understand what you're buying into. And another thing about construction assets is that, okay, it's been built, that's great. It's performing well, that's great. But what about 10, 20 years down the line, when the asset stops working and you have to dismantle the asset? What about then, when you have no clue how to dismantle the asset? That's again where the specialists who've built the asset will know how to dismantle it, or the specialists who specially decommission or dismantle the asset. And you have to obviously incur costs to dismantle the asset as well, which you wouldn't think about right now, because it's 10, 20 years down the lane, but you'll be end up paying for that. So you'd have to keep that in mind. And engineers are the ones who sort of help us with an estimate of what the decommissioning or the dismantling cost of the asset would look like. And that is something which then feeds into the financial model. Moving on, other considerations, which is just, this is something that it's very relevant right now, because yeah, we are drowning in information, but we are starving for knowledge. So like I think Shraddha had mentioned in her previous session, there's just so much of data and information available. How do we use that to arrive at some meaningful assumption or value from it? Similar thing with M&A transactions. You're investing in a company. The company has so much of data. You have so many things to look at. Like I mentioned, financial, tax, human resources, environmental. What do you look at? Like, I mean, what are the key things that you want to look at? Because if you end up looking at everything, you'll just be spending a lot of time, and you wouldn't want to waste your time looking at something that's not relevant at all. So you'd want to thoroughly clean your data and go through your data. And this is where data analytics is very handy, comes in very handy in M&A transactions. And I've personally done a few of these in due diligence projects as well. So the tools that we use is Microsoft Excel. That's the basic one. That's like our bread and butter for our transactions. A few other ones that we've used are Power Query, Tableau, Alteryx, R programming, Python, because that's how you analyze your data, and it simplifies your life in going through such a large volume of data. Visualization as well, because when you're analyzing the data, you know where the start point and the end point is. But when you're presenting your data, or when you're presenting your analysis um, to the partner, or just reporting on it, or to the other company, you want to visualize your data and you want to show it. Visualization is just coming up with a story behind the data, and these tools definitely help in creating that story. Um, and the types of data analysis that have been performed using these tools are: you set KPIs or you identify KPIs. KPIs are your key performance indicators. So for say a wind farm company, what could be your key performance indicators? Some of them would be um, how fast is the wind blowing? At what rate is the wind blowing so that it enables your wind farm to generate electricity. How much of electricity is being generated? These are just some of the key performance indicators that you'd want to stress upon. You'd obviously want to omit useless data because you just want to focus on the core part and not the non-core part. You'll conduct a lot of statistical analysis to get a more clear picture, such as cohort analysis, cluster, where, say, for example, for a where you have thousands of customers, you'd want to just focus on your key customers, say the top 10, and the top 10 by value, or the top 10 revenue generating customers, and you'd want to focus on them. And one way of analyzing these top 10 customers is by doing a cohort analysis. And then when you're doing that analysis, you know, okay, these were my top 10 for year one, but are they the same top 10 for year two as well, or are they different customers? So these are just some of the useful analysis that are performed. And then these data analytic tools are also very useful for data modeling, visualizing data, as I said, and just in performing a real-time analysis where you don't have to. So if you're getting data for, say, December, and then you performed your analysis, and then it's January or February now, and you have to again perform the same analysis. So these tools help in performing the analysis on a real-time basis, so that you don't have to start from the scratch again when you're getting your data in February. And so the process of the data analysis is uh, it's quite regular, quite simple, where you'll clean your data, you'll try to get a clean set of data. You look for some data points which do not look regular, so you'll focus on the irregular data points, or anything that is going up and down, or anything that is showing you a trend. You'll want to sort of focus on those. If there's some wrong data which is quite obvious, where it could be a typo, or it could just be some error in the system, that would be a good way to figure out or to understand that, okay, this is showing an error. This is the system that's showing the error. Why is it? And that also sort of helps you in identifying the system that the company is using and ways in which they could improve by using the system. With that, you have a lot of missing data as well that you'd want, which as you start analyzing your data, you'll get to know that, okay, I'm probably missing um, some data for, say, my customer analysis, where they've just given me 100, but you know that there are thousands of customers. And like I mentioned, yes, you'd want to watch for important patterns, where the trends, or if there's anything going down in a particular year which shouldn't be, or if there are any excess costs being incurred in a particular year which shouldn't be, or if there are any one-time cost which, in say, in year one or two there was no cost happening, and in year three suddenly you see a jump in IT infrastructure of 100. What is that? Is that a one-time cost? Is that going to happen regularly? Because if it is happening regularly, you will end up having to pay for that. And if it's a one-time cost, it could be a capital expenditure cost, which, you know, okay, they're trying to better the system, and this cost might be for that. And I think once you just get into the data, you start off thinking more about the data. And because due diligence, the whole process is about questioning your data and challenging what's in front of you, you start coming up with questions of, why is this way, or why is that happening that way? And yeah, I think it just gets very exciting when you have your data set in front of you. You look at the data, and you start figuring out, and you start analyzing and coming up with questions. And yeah, it's a very helpful process in the due diligence process, because once you have your questions, you can go back to the management team with them, sit down with them and discuss these questions. And that's when you know if they are comfortable answering them, if they're not comfortable answering them. And this is how you'll understand whether what you're getting into, or the investment that you're getting into, is correct, whether the price you're paying for it is right, and stuff like that. Um, so I think that was more or less about due diligence from my part, just a basic holistic overview. And if you have any questions, please feel free to use the Q&A tool. Okay, I see one question. Why would any company disclose their margin profits to other company or stake acquirer? How MNCs analyze the asset of any company using financial due diligence? Okay, so if company B wants to sell its assets and I'm company A, and I initially use the information that is available publicly to get a brief overview of the company B, and just to get a brief like an estimate of the price that I want to pay. But of course, if then I'd submit that price to company B, and if company B is comfortable getting that price, then they'd want to share more information, because obviously I'm not just going to buy the company based on a estimate, right? I'd want to pay a good price or perfect price for that after doing my thorough analysis. And when company B and A get into that agreement, that's an agreement that company B wants to sell its assets to company A. And company A can only get comfortable when it knows more information. And that's why company B will disclose the margins, profits, the customers that they have, or they may not disclose customer names, but they will definitely disclose what revenue they are getting from customers and stuff like that. And how MNCs analyze the assets of any company using financial due diligence. So this is an interesting question. Um, um, MNCs would, so as I said, in a financial due diligence scenario, you have financial statements that you look at, which are your income statement and balance sheet. So in a balance sheet, you usually have your assets and liabilities. Your assets would, yeah, the assets are what you would then analyze and go into deeper, such as how have you capitalized the asset? How have you paid for the asset? How much have you paid for the asset? How much are you depreciating the asset by every year, so that by the end of the life of the asset, you have some useful life or some zero value. And based on the value that is currently standing in your books, so suppose you bought an asset for 100 in 2 years back, and you're depreciating it at 10% or something. So by now, 20 rupees of that asset value would have eroded. So today you wouldn't want to pay the price that you paid 2 years ago. That is 100. So today you'll pay 100 minus 20, that is 80. So that 80 is what you would analyze and pay for. I hope that answers the question.
So thanks, Vidhi. This was a good talk. Does anyone have any other questions? We will be having 2 more talks tomorrow. The first one will be on startups, and we have a person working for the governments of Goa and Uttarakhand to come and give a talk. And we have another talk on agile methodology of coding.
So I have one more question. Any suggestion one should take care for new startups? Yes, for tech startups, I think one thing that you should sort of, it's a good practice from day one that you could do is um, the documentation part that goes into building your IT architecture and infrastructure, and sort of keeping that documentation in place, and maintaining your systems, so that when you in the end do decide to sell, or do decide to merge with another company, you wouldn't want to spend too much at that point of time. So I think it's a good practice to sort of do a regular health check, like an annual health check of your systems, and invest into the health check, and um, maintain your systems, just so that at the end you don't get a shock when you're trying to get into a transaction. Um, yep, I hope that's answered the question. Over to you again, Prateek.
Okay, thank you. Thanks a lot, guys, for attending. And Tomorrow the time is 7:30. 7:30 to 8:30 is the first talk, followed by 8:30 to 9:30. We're having this late because the second speaker is from the US and there's a big time difference. And thus we couldn't help that. So it is good. Do let me know if you have any concerns. You have our email IDs, you can share your feedbacks. And thank you very much, guys. Good night. And thanks a lot for joining.
Thank you all. Bye-bye.
Thank you. Bye.